Morning. Welcome to Stock Market Today for Thursday, March 5th, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com /today. Sign up for a free email where you can get a lot of the content for this show, as well as daily stock ideas for you to consider. Hit your inbox every trading day before the market opens. So U.S. equities were higher on Wednesday, closing near the best levels of the day. All sectors were up, led by healthcare. Consumer discretionary and financials lagged. Treasuries were mixed with the curve steepening. Dollar was stronger versus the euro and the yen. Gold was down 10 basis points, and WTI crude was down 80 basis points. But as we get to the desk this morning, futures are down nearly 2% in early trade as Asian markets rallied overnight, with China, Hong Kong, Japan, Australia, and South Korea all up over 1%. European markets are under pressure, however. Treasuries are stronger, so that flight to safety continues. The dollar is weaker on the major crosses. Gold up 20 basis points. WTI crude up about 10 basis points to get us going on a Thursday morning. Let's take a look at the structure of the S&P 500 here. I think we're going to be range bound is the name of the game, and these are kind of tentative levels so far as we start to carve out those ranges. I think two-way volatility is going to be in play for a while, right? We're seeing 3 and 4% moves on a daily basis for the S&P 500. I think we need to get used to that for a little while until we carve out some level of support from which we can start to maybe build a sustainable base or potentially break down. Who knows? Right now, I'm calling support in the area, between 2,900 and 3,000. Right. So we draw the line here at around 2,950, which is where the market closed on Friday afternoon. I think resistance is in the zone between 3,100 and 3,200. So middle of that range is 3,150. Again, these are slightly tentative. We're still nothing strong or weak here given the fast movements. RSI is still in bearish ranges. Chaikin money flow is bullish. What's interesting to me, and the title of today's presentation or the show is 50% retracement. This low was a 50% retracement of the December 2018 to February 2020 advance. And I'm going to show you another 50% retracement a little bit later on in the show. Taking a look at our market in a minute now. What are we writing about in our note today? Well, stocks rally as volatility remains a major factor. Remember, volatility cuts both ways. Everybody always likes to talk about, oh, the market's so volatile when the market's down. Well, there's upside volatility as well, and you saw it yesterday. The initial rally has retraced 50% of the decline. We'll take a look at that a little later in the show. As I said, breadth metrics improve, but are not at healthy levels. Small caps lagging, and we're wondering if support will hold. And then futures point to a lower open here today, as I said. Taking a look at the power bars now for the major indices. The Dow adds 4.5% yesterday. 3 to 6, bulls to bears. S&P 500 up 4.25, 62 to 104, bulls to bears there. NASDAQ actually flips positive on the bull-bear ratio after 4% rally. 20 bulls to 13 bears there. Small caps, there it is. Small caps lagging. And if you look at the IWM, we're pushing on the string of support at around the 145 level for IWM. Up nearly 3% yesterday, but massive underperformance. 203 bulls to 402 bears. Bonds down tick, sending yields higher. Healthcare, biggest winner yesterday. Up 5.75% for the healthcare group. Largely a function of the managed care names. And when we look at the movers and shakers a little bit later on in the show, you'll see what I mean. According to the Chaikin Barrel Bar, small cap stocks are more bearish than large cap stocks. Major markets across the board are mixed. Our stock of the day, Meridian Biosciences, was up 7% yesterday. Massive move. But this is an $8.56 stock. Stock of the day auto-generated based on the power gauge rating, which is very bullish due to very attractive financial metrics, very strong price volume activity, positive expert activity, weak earnings performance, but 20 factors, 5 in each of these 4 categories, very bullish stock. Above the long-term trend line, so the trend is strong. The group is weak, though, healthcare equipment. And what I see here is a very bullish stock that's underperforming the market with bearish money flow and is overbought within the context of this trend. So while the power gauge rating is there, remember, there's more to it than just the power gauge rating, right? We want power gauge rating. We want relative strength. Then we want oversold with bullish money flow. you want to add Vivo to a bullish watch list and see if things improve, great. But to me, there are much better names in the healthcare space that you could be looking at right now. You don't have to, in my opinion, pay a lot of attention to something that's underperforming, that has bearish money flow. It's still very much in a downtrend, right? Doesn't look that interesting to me. Pass. Sector tracker now, movement in the major sectors over the last 5 days. We have healthcare at the top of the list. See what I mean? Healthcare's a big outperformer of late. Why? There are other names there. You don't have to go to the name that's underperforming within a group that's outperforming. Go find the winners. Staples, top of the list. That's defensive positioning. Utilities, defensive positioning near the top of the list. Also, declining interest rates. Materials, I'm still unimpressed by the materials. It's a group I would continue to avoid. Tech, we like it. We have liked it. We continue to like it. Biggest weight in the S&P 500. So if you want to look for positive developments, you want to see tech outperforming. Real estate rounds out the list of groups that have that are positive over the last 5 days. Again, that's an interest rate play. Comms, discretionary industrials, middle of the road. Energy remains the disaster that it has been for a few months. I feel like a broken record. I'll keep saying it, though. Until something changes there in a meaningful way, I refuse to get excited about energy. And I want to get excited about financials, but I can't with this interest rate environment. And having a process bears that out. It doesn't matter what I want. It matters what is. And what is interest rates are moving lower, and that's a headwind for the financials. Now, what I will say is there are pockets in the financials that have done well, right? Like the exchanges and then the information providers like SPG, like S&P Global. But for the most part, financials, stay away from the banks at the very least. Our industry in focus today is healthcare equipment services, which over the past 6 months has outperformed the S&P 500 by 55 basis points. However, the power bar ratio here is weak. 15 bearish or very bearish stocks for only 6 bullish or very bullish stocks, currently ranked number 9. 21 subsectors, having moved up 1 slot, right? So the names we want to avoid there: cardiovascular system, CSII, Neogen, NEOG, and Mesa Labs, MLAB. I would also highlight Vivo, the name that we just looked at comes out of this group as well. So we want to avoid the very bearish names here, and despite the near-term outperformance for the group. And I think it's a mixed picture. If we look at XHE as a whole, right? Neutral ETF power gauge rating, 15 bearish stocks, 6 bullish stocks. We looked at that. Weak trend below the declining long-term trend line. Now, money flow is bullish. We are oversold. We're outperforming. But we have a neutral rating. So there's enough here to kind of keep it neutral. I think if you want to go searching for ideas, you can drill down on the 6 stocks that are holdings of this fund. Like I said, I like healthcare. I think you need to be selective in this market. You always need to be selective, but more so now in light of the volatility in the marketplace. Kind of interesting to me. 6 bullish or very bullish names. You can start to take a look. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. The gainers side of the board, all 5 of these names come out of the healthcare space. All 5 of these names come out of the managed care space. All 5 of these names benefited from the fact that Joe Biden had a strong showing on Super Tuesday, thereby decreasing the odds that Bernie Sanders will get the nomination, right? These names stand to lose the most if Bernie is nominated and potentially gets into the White House because of his Medicare for All plan. That would be very, very negative for these for-profit service providers and payers within the healthcare space, right? No two ways about it. A lot of push and pull about what was happening in the market and the types of names that were outperforming. But I think these 5 names, it was very specific to Joe Biden's strong showing on Super Tuesday, thereby diminishing the odds of Bernie Sanders getting the nomination, right? Not often that we can lump all 5 winners into one group, but we can today. On the loser side of the board, Digital Realty, DLTR, down 3.5% following their earnings announcement. Halliburton, HAL, part of that disaster of an energy sector, hit a 52-week low yesterday, down 3.5%. Schwab gave out some data on daily active trading. down 3% yesterday. HPE, Hewlett Packard Enterprises, down 2.5% plus 2.6% following their earnings announcement. And Kohl's, KSS, following through to the downside after their earnings announcement the previous day, sent the stock lower. So more company specific over here. Winner side of the board is election specific. And remember what I've said, healthcare is going to be volatile, I think, as we move towards the election. All right, I said we'd look at 50% retracements. Remember last week we looked at the move from December to the high in February of this year, and we started highlighting key retracement levels, the 38.2% retracement, which is a fib level, 50%, which is not a fib level, but it is a key retracement level, as well as 61.8%, which is a fib level. And we showed you where that level was. What's interesting to me is Friday's low tagged the 50% retracement of that big advance and then steep decline. So now we want to start thinking is, right, you've heard us talk that, or if you've written in our notes, if you've read our notes, we've written that we think odds favor a retest of the lows at some point. All right, but the question is, how high could we potentially bounce in the interim? Well, we've hit a 50% retracement of the decline, right? Here's the high on February 19th. Here's Friday's low. We've retraced 50% here to the 31.23 level. Now 61.8% retracement gets us here to the 31.87 level. Should that break, I think we're probably going to try to fill the gap before potentially heading lower and retesting the lows. What are we looking for on a retest of the lows? Well, we've written about it. We've talked about it. We'd be looking for less intensity. And I'm going to point out what that means a little bit later when we do breadth, because on Thursdays we do market breadth and our note for Jake and Analytics clients. So I'll highlight what I think it means to have a less intense low. Should we retest? Are we guaranteed to retest? Absolutely not. We could blow through these fib levels, close this gap, and just keep going. We're not guaranteed. Do I think that that's the higher probability event? No, I don't think that that's the higher probability event. I think ultimately, we'll see some choppiness. Notice our S&P 500 futures are down 2% this morning, right? So we've hit this 50% level, and we're already starting to pull back 2%. Is this the retest? I don't know, right? But I think you need to have a game plan. If this, then that. I think that if you were scooping stocks on the 50% test here, it's probably a good idea to be letting some go on this interim rally, right? Manage your risk. Volatility's high, probably going to be high for a little while. Manage your risk, right? If you bought some down near 28.50 on the SPY or the S&P 500, good for you. Great trade. How upset would you be if you gave it all back? Manage your risk. Move your stops up. Manage your risk. Rally is defensive so far, right? So we've seen a 50% retracement, right? This is a sharp rally. I mean, look, we're almost 300 points to the upside. Sharp rally off the lows. Very defensive in nature, though. Taking a look at the relative rotation graph of the S&P 500 sectors, right? We still have tech leading. We like tech. We also like comm services. We've been writing about that for a while because we like both the offensive and defensive properties, right? But after that, look at the leadership. Utilities, that's defensive. Real estate, well, that's defensive. Staples, well, that's defensive, right? Look what's underperforming, your cyclicals. Look at here's your energy disaster, right? All the way down into the lower left-hand corner, right? Materials, industrials, right? Cyclical in nature. Financials, obviously, feeling the pain of interest rates falling. So very defensive in nature, this rally so far. Largely a function of those lower rates. And then finally, breadth improves, but it's not healthy. Percentage stocks above their 200-day, still below 50%. 50-day, still below 30%. What we'd want to see on a retracement or a retest of lows is a higher low on these metrics. That would constitute less selling intensity, right? So that's what we're looking for. So breadth has improved, but it's still not healthy. That'll wrap us for today. Head over to shakenanalytics.com/test drive to sign up for your 14-day trial. I'm going to be back here with you tomorrow. Have a great Thursday.